What is net income in banking? Now that you understand the efficiency ratio, the next major banking concept is net income. Because at the end of the day, every bank and credit union wants to answer one simple question. How much profit did we actually earn? That answer is found in net income. Net income is the amount of profit a financial institution has remaining after all revenue, expenses, taxes, provisions, and losses have been accounted for. In simple terms, net income is the bank's bottom line. It's one of the most important indicators of financial performance. Banks generate revenue from many different sources. This includes interest earned on loans, investment income, service fees, debit card interchange income, treasury services, and other financial products. But generating revenue is only part of the equation. Banks also face expenses. These expenses include employee salaries, technology investments, branch operations, compliance costs, fraud prevention, deposit interest, loan losses, and operating expenses. After all of those costs are deducted, the amount remaining becomes net income. This is why strong revenue alone does not guarantee profitability. A bank can generate billions of dollars in revenue, but still experience weak net income if expenses and losses become too large. Financial institutions monitor net income closely because it directly impacts capital growth, lending capacity, shareholder returns, and long-term stability. Strong net income helps banks build capital, expand operations, invest in technology, improve services, and support future growth. Weak net income can create challenges. Profitability may decline. Capital growth may slow. Lending activity may become more conservative. Regulatory pressure may increase. This becomes especially important during economic downturns. When loan defaults increase, deposit costs rise, or economic conditions weaken, net income can come under pressure quickly. Credit unions also monitor net income carefully. Even though they are member-owned institutions, profitability remains essential for building capital, supporting members, improving services, and maintaining financial strength. Net income is also closely connected to many concepts you've already learned. Net interest. Margin impacts revenue. Cost of funds impacts expenses. Risk management affects losses. Efficiency ratios influence operating costs. ROA and ROE help measure how effectively net income is generated. Together, these metrics tell the complete story of a bank's financial performance. At the end of the day, net income represents the final result of every major banking decision. Because in banking, profitability isn't measured by revenue alone. It's measured by what remains after every expense, risk, and cost has been accounted for.
Disclaimer. This content is for educational purposes only and is not legal, compliance, or financial advice. Please consult a qualified professional before making any financial decisions.